Okay.
We'll try it this way.
I don't know. Well,
So stagflation, how worried are you about
well,
it?
first of all, we see inflation increasing substantially. It has been a surprise to an extent because probably we as the overall community of central banking, but also policymakers and analysts and so on, did not foresee the bottlenecks between supply and the difficulties to match the increase in demand across the globe. But actually, energy prices have spiked up much more than justified by the excess of demand. And a simple measure, the one which I mentioned in the ECB Watchers meeting last week, is very simple. In Europe, gas prices increased by 10 times on average, 8, 9, 10 times, between early 2020 and February 2022. In the United States, twice. So this is not really a measure of excess demand. It's a measure of the difficulties we have been facing during the year, last year already with Russia. This is the price part. What is the effect of that? Obviously, the purchasing power of households goes down, and therefore there is a demand effect. So we have at the same time a supply shock and a negative demand shock, not a positive demand shock in Europe.
But this is what nightmare scenario. This is a worst case scenario on both cases.
This scenario we are seeing. It is worse. I don't know. It may be worse if there is shortages, as has been mentioned, in drastic shortages in gas supply, oil, if the imports from Russia are completely cut off and so on. But the issue of stagnation is a different issue because it is very much dependent on the reaction of policy. And there are various kinds of policy reactions. Clearly, a supply shock and this kind of negative shock, it cannot be countered simply by monetary policy doing something. It is the fiscal responsibility. There are costs. We have to remember in this case that the worst response is higher inflation through increases in incomes and nominal incomes and so on, because that does not redistribute the tax. The tax, which is an external tax to us, has to be redistributed towards those who are mostly hit, the poorer and the business sector that produce jobs and activity, and or over generations with costs.
But Governor, what can monetary policy actually do? So I know you've just said it's pretty limited. I know the market is expecting 2 hikes. Is that how you see it developing? Is the market right? Is there a mismatch with what you think will happen and the market is pricing in right now?
No, I think that there is uncertainty. And the response that we are seeing is a response to uncertainty. If there is one word that I would really use, is this one coupled with disbelief and grief, basically. So, and this uncertainty has had an effect on markets of clearly somehow looking with more care to the exposures, direct and indirect exposures. This is why the banking sector has most severely hit. This is why the high yields we have seen this high increase in corporate spreads. But overall, markets have remained, I would say, relatively calm, obviously helped by the high liquidity that has been and is maintained, supplied and is maintained by central banks.
Governor, you've always been very measured and actually always had a very clear view on what you thought monetary policy should be. Are you more uncertain now about the way forward and what should happen to rates and what should happen to APP and PEP than in the past?
What action by whom? I mean,
by central banks. How do you see monetary? What do you see the ECB doing?
No, you see, monetary policy in Europe is something. Monetary policy elsewhere is something else, and this is a crucial thing. I mean, if you consider what's happening in the United States, it's obvious that monetary policy can only be restricted there. There is a clear demand shock. It is summarize in one simple figure. In 2020, the GDP growth fell, reduced. The GDP fell by 3 and something percent in the United States, and disposable income, household disposable income increased by over 6%. In Europe, it fell, but also GDP fell, but 5%, but also disposable income was reduced. There was compensation from the fiscal side, but it was not overcompensation. So this is what we are seeing there. In Europe, I don't see a major demand shock at all. I see supply shock, co-uncertainty, which goes in the other direction. There is a risk, and the risk is what normally is called second-round effects. What are second-round effects? They are, first of all, inflation expectations getting de-anchored. That is, we have been extremely successful in the last 5-6 years in fighting the risk of deflation. There was a material risk of deflation, and deflation with debts would have been really terrible, and we have been able to fight it completely. Now, we had a new strategy in monetary policy. The strategy has a target which is 2% symmetric. We have been able, also helped by the increase in costs, by the way, to see expectations going back towards 2%. They are not being de-anchored now. And also, we are not seeing excessive wage increases in Europe. As a matter of fact, negotiated wages still are on average at 2%, while in the United States they are 6%. There might be pressure. We know that we have to be very careful on that. If fiscal policy is able to reduce the heat in the pass-through to final prices, or in the helping those who are the households which are mostly hit, then we may have less demand for indexing to the energy component of the increase in costs. And therefore, if the war does not last too long, and as a matter of fact, if peace comes back, which what we all hope, and the sufferings are drastically reduced, then I think we may certainly not have a stagnation with inflation. Inflation may go back.
How soon could that be? And again, is there a danger at the moment? I know it's hard given the uncertainty, but is there a danger that the ECB, because it's pulling away stimulus during these shocks, is putting growth to one side to focus on inflation?
Well, basically, we are coming out from a monetary policy stance which was well defined in a deflationary period. Or disinflationary, or strong disinflation. We had a number of instances in which actual prices were going down, and on average a number of countries and so on. Now what we have decided in December is to start a gradual normalization of monetary policy. Gradual with a new word, and the word is optionality. What does optionality mean? There are two words which have to be defined, flexibility and optionality. Now, optionality means that all options, of course, are open. We are in this state of uncertainty. We can only see the risks now in the very short term. We consider that going somehow reducing our purchases and then ending them, which were designed to cope with deflation risks, is something that normalized gradually. We want to maintain a smooth financial market working, and therefore we will keep maintaining favorable financing conditions. We have now very, very negative real interest rates. It is, I think, a normal world. A world in which we have to go is a world in which real negative rates are not there anymore.
But we had that headline again from Vladimir Putin possibly asking to be paid in rubles. That would be problematic. So if we have a shutdown of gas and oil, we'll see more of a shock. What does that mean for stimulus? Could you see stimulus being withdrawn even sooner?
Well, we have to define what is a stimulus. If the stimulus is the level of liquidity, the level of liquidity remains there. If the stimulus means that we are going to reduce our balance sheets, this is not going to happen soon. As a matter of fact, we are discussing how to reinvest the special pandemic asset purchasing program, how to reinvest when bonds end. There have to be somehow replaced with new bonds. The issue here is how we define normal conditions. And this is why I think, since we are not in normal conditions now, we don't know what the new normality will be, we have to be careful. And
how would you define them?
Well, we have said we remain open. We look at what's going to happen now. We remain open. My reading is that, I mean, there's been a lot of discussion between hawks and doves, those who want. Frankly, I'm pretty offended by definition of those, since I fought very much against deflation. And deflation is, you have to be very hawkish to fight.
But I think there was also an owl.
Huh?
There was also an owl.
Well, well, the point is that on inflation, I think that if there is second round effects that are a combination of two or three things: nominal wages that are picking up excessively, inflation expectations that are de-anchoring, and the exchange rate, which we do not target, but obviously we take into account when we look at imported inflation, then it is the responsibility of central banks to stop that. But at the same time, the central banks works and has worked very well during the pandemic with the fiscal authorities. And I think the de facto coordination should continue. If fiscal authorities help, then we can be gradual and consistently go towards what will be a more normal level of interest rates.
So I know not to call you a dove, but from you personally, do you worry more about inflation or growth at this juncture in time?
Yeah, of course. I worry.
More about inflation?
Well, I worry about inflation, and I think that we should be very careful and watching at all the new data that come out. But at the same time, if we look at the expectations of analysts that are surveyed by us, if we look at the projections that somehow come with scenarios, now it's very difficult to rely on point projections. Well, they all say that at the end, the supply shock will be somehow accompanied by a reduction in inflation expectations. As a matter of fact, now, not only are they well anchored around 2, but in case they're a little bit below 2 in the next couple of years. Yeah. So in this sense, we have to not to surprise too much, not to add to uncertainty, not even to talk too much, and I'm already an exception here.
Governor, what do you think that governments should do to help with keeping energy prices low? What's the right way to look at
this? This is a tough question, of course, because on one side, I agree with what has been said. We should prepare ourselves, be better prepared with differentiating better the sources of energy. There is the risk that for the time being, while the targets for the net zero remain as they are, the trajectory may be put somehow in question. There is, and obviously I'm not in favor of removing totally the price signal that comes from the cost of fossil energy sources, because at the end it is these price signals that encourages investment in the clean energy or in the green that we want. But this said, for short periods, perhaps some action also on caps or what I call administered prices might be seen. I read a journal article today in the Les Echos by Marc Victory, who mentioned what I said in this sense. I agree with the Governor of Bank of Italy when he says that for a short time in this kind of situation, administered prices may help clearly, but obviously the risk is how to get out from them. And this is, and I totally understand that. This is the challenge. On the other hand, now with gas prices, which are 10 times what they were 2 years ago, it is obviously we are putting a major stress not only on consumers' confidence and so on, but on the activity of the industry sector itself. I mean, there are a number of, especially small and medium enterprises, who cannot survive at these prices. So something has to be done. This is not the responsibility of monetary policy. Monetary policy listens and goes on with the wise decisions by governments.
Very wise. Governor, we're out of time, but one final question on Italian growth. Given what we've seen in terms, well, given the war in the last 3 to 4 weeks, will you have to revise your growth forecast lower for Italy? Will it be more around 3%?
I don't understand what is the question.
The GDP forecast for Italy, will it change because of supply shocks?
But I try to say that it is point forecast now is not what's going to help. What is going to help is scenarios.
Yeah.
Now scenarios, you can do scenarios giving assumptions, starting from assumptions and then trying to see. One assumption is that energy prices remain as they are now. What happens there? Mechanically, this implies for 21-20 this somehow constellation of prices a fall in purchasing power of about 4 percentage points over the 2 years. So this is a drag. Does it send us in recession? Not really. It depends from all the rest, and the rest is confidence, of course, is the role of sanctions, is if the sanctions are not only have direct effects, but also indirect effects on us, because there are indirect exposures to the firms who are hit by the high level of energy costs and those who actually have trade with the Russian counterparties.
And Governor, what you're saying is very powerful, because we have to look at scenarios. When do you think we'll have a better idea of the second, third round effects? Is it a couple of months? I mean, we you know, in the past, we haven't really dealt with such a big situation where you have to freeze out the 11th biggest economy in the world. So how much time does it take for us to understand the ramifications of everything?
Well, we have to study a lot and get all the information. And this is what we are doing. But obviously to answer this very, very wise question is impossible. I have no idea how much. We are living more or less on the day while we are planning ahead of time. But this is the optionality. Now, if this is the optionality on our side, I think as far as governments are concerned, they have to consider the impact on the incomes and on production activity and try to devise way. But if things go bad, very bad, I think that Emma is right. I mean, we have to act very quickly, we will suffer, and then we'll go through. This is wartime. And in wartime, it's very difficult really to have neat and clear-cut analysis and project. We have to try to do our best, and we have to be united. The big thing that I have to say, I'm very disappointed, because I thought the G20, the IMF, and so on were not only institutions where good decisions would be taken, but also institutions that would be very helpful to maintain peace in the world. Because of the confidence that you have with your counterparties, the friendship at times, and so on. Now, this may not have worked as much as we wanted. As a matter of fact, has not worked at all in a number of circumstances. But what is clear is that there has been a very strict coordination in answering to the Russian invasion to Ukraine. The sanctions certainly, but also the united response of citizens on. Apart from what we see, there are various points, peace, obviously everybody wants peace and so on. But at the end, the very end, there is, I find, an ability to be united. And this is really the only way to respond to this kind of terrible shocks.
Governor, thank you so much for your time today. So